There are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and you know, it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Well, I can remember when you bought one membership in some duck club that had oil under it when you were young.
Yeah, there was a company called Atlas.
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlas, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, you know, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, you know, is that an efficient market or not? You know, $29,000 for $20,000 of cash plus $11,000 of royalty income at 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future.
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in, and I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, you know, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce, but the stocks as a group were so cheap that you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future, I would have bought that also. Incidentally, I've written in the last annual report about Geico, and I bought that stock in 1951 when I had about $10,000. And Geico, I bought, or I looked at, because Benjamin Graham was the chairman of the company. But Geico was exactly the sort of stock that Graham wouldn't buy. I mean, it was selling way above book value and all of that. There was a certain irony in that, but I'm glad I did it.